Let me ask you something. How much money do you have sitting in your bank account right now? $5,000? $20,000? $50,000? If your answer is a lot, this video might be the most important thing you watch this year. Because here's the truth nobody tells you. Keeping too much money in a bank is one of the biggest financial mistakes you can make. And millions of people are making it every single day without even realizing it. I'm not saying don't use a bank. I'm saying there is a specific number, a ceiling, above which your money starts silently working against you. Stay with me. By the end of this video, you'll know exactly how much to keep, where to put the rest, and why the banks are counting on you not knowing this. Most people keep large amounts of money in a bank because it feels safe. And honestly, that feeling makes sense. Your money's insured, it's protected, you can access it any time. But here's the problem. Safety and growth are two completely different things. When your money just sits in a traditional savings account, the average interest rate you're earning is somewhere around 0.4% to 0.5% per year. Meanwhile, inflation, the silent thief, is running at anywhere from 3% to 6% annually. Let's do the math. Say you have $50,000 in a regular savings account. After 1 year, you earn maybe $200 in interest. But inflation quietly reduced the purchasing power of that $50,000 by $2,000 to $3,000. You didn't lose money on paper, but in real life, you lost money. You just didn't see it happen. This is what financial experts call the inflation trap, and most people fall right into it without ever realizing it.
Now, let's talk about the number, the actual ceiling. In the United States, the FDIC, the Federal Deposit Insurance Corporation, insures your bank deposits up to $250,000 per depositor, per bank, per ownership category. That means if your bank fails, and yes, banks do fail. We saw it happen with Silicon Valley Bank and Signature Bank in 2023. Any money above $250,000 is not guaranteed. So the first hard rule is this: never keep more than $250,000 in a single bank account. But honestly, for most people, the real number should be way lower than that. Because even if you have $80,000 in the bank, you're not in danger of losing it to a bank collapse, but you are losing it silently to inflation every single year. The $250,000 limit is the legal ceiling, but your personal ceiling should be based on something else entirely: your emergency fund.
Here's what every financial advisor agrees on, and this is one of the rare times they all say the same thing. Keep 3 to 6 months of living expenses in your bank. That's it. If your monthly expenses are $4,000, rent, food, utilities, transportation, then your ideal bank balance is somewhere between $12,000 and $24,000. That is your emergency fund. That is your security blanket. That is the money you need liquid, accessible, and safe. Everything above that number, it should be working harder for you somewhere else. Now, some people say, but what if I need more than 6 months? What if I'm self-employed? Fair point. In that case, maybe you keep 9 to 12 months of expenses. But even then, there's still likely a large chunk sitting in your account that's doing absolutely nothing. The point is this: your bank is not an investment vehicle. It's a parking spot for short-term needs. Treat it that way.
Okay, so you've calculated your emergency fund. You know your ceiling. Now, what do you do with the rest? Here are the most common and effective options, starting from the simplest. Option 1, high-yield savings accounts, HYSAs. These are still bank accounts, still FDIC insured, but they pay 10 to 20 times more interest than a traditional savings account. We're talking 4 to 5% annually right now. Platforms like Marcus by Goldman Sachs, Ally Bank, or SoFi offer these. Your money stays liquid, but it actually grows. Option 2, Treasury bills and I-bonds. These are backed by the US government, literally the safest investment on earth.
Treasury bills can pay around 5% per year with very low risk. I-bonds are designed to match inflation, so your money never loses purchasing power. Option 3, index funds and ETFs. If you have money you won't need for 5+ years, the stock market historically returns around 7 to 10% per year on average. You don't need to pick stocks. You just buy an index fund, like one that tracks the S&P 500, and let it grow over time. Option 4, real estate or REITs. Not everyone can buy property, but REITs, real estate investment trusts, let you invest in real estate with as little as $10. They pay regular dividends and have historically outperformed inflation significantly over time. The key takeaway here is simple. Your money should always be doing something. The moment it stops working, inflation starts winning.
Here's something the banks definitely don't advertise. When you deposit money into a bank, the bank takes that money and lends it out to other people. Mortgages, car loans, business loans, often at interest rates of 6%, 8%, even 20% for credit cards. They're making money off your money, and they're paying you 0.4% for the privilege of using it. It's one of the most brilliant business models in history, and there's nothing illegal about it, but you need to understand what's happening. Every dollar you leave sitting in a low-yield account is a dollar that's making your bank richer, not you. Now, you might think, okay, but my money is safe and accessible. And that's true, but safety and accessibility are worth something, not everything. You can have both safety and better returns. You just have to be intentional about it. Before we wrap up, let's go over the 3 most common mistakes people make. Mistake number 1, keeping multiple months of savings in a checking account. Checking accounts earn almost 0 interest. Move anything beyond 1 month of expenses out of checking and into at least a high-yield savings account. Mistake number 2, thinking more money in the bank equals more financial security. Security comes from having a diversified financial plan, not from a big bank balance that inflation is quietly shrinking. Mistake number 3, waiting until you have enough to start investing. There is no perfect number. If you have $1,000 above your emergency fund, that $1,000 can start working today. The best time to start was yesterday. The second best time is right now.
So, let's recap. Keep 3 to 6 months of living expenses in your bank. That's your emergency fund. Keep it in a high-yield savings account if possible, not a standard savings or checking account. Never exceed $250,000 at a single bank without understanding the FDIC limits. And everything above your emergency fund? Put it to work in HYSAs, treasury bills, index funds, or real estate. Your bank is a tool. Use it like one. If this video opened your eyes, share it with someone who has too much money sitting in a savings account right now. They'll thank you for it. And if you want to learn exactly how to build a diversified financial plan from scratch, hit subscribe. That's exactly what we cover on this channel. See you in the next one.